Palantir stock is a top subject of today's video. We're going to speak about this one right at the beginning here. I want to talk about the stock price and what is so shocking about what is going on right now in regards to Palantir. So we're going to speak about that. Then I want to go ahead and kind of react and kind of share my opinions on why Bank of America just raised their price target on Palantir to $75. Yes, $75. So looking forward to talking Palantir here at the beginning of the video. Then we're going to react to three videos in this one. First one up here is from Ed Denny talking about the S&P 500 could hit 7,000 at this time next year, roughly. That's insane, okay? So we're going to go ahead and react to that one. Trump policies could start to have an economic impact in the spring or summer of 2025. I think that's an important video to react to there. And the reason being is a lot of people are, obviously new administration coming in January, but a lot of people are trying to figure out, okay, how long does it actually take for, let's say, changes that are being made to actually be felt positively or negatively in the economy, right? And so I think that's going to be an important video to react to. And then last one up here, this one's actually going to be really interesting. The American Express CEO spoke to CNBC talking about revenue targets are not too aspirational. That's an important video. Whenever Amex CEO or Visa CEO has anything to say, that's the economy, man. And so you want to hear what those sorts of companies are saying. Same thing with UPS CEO, FedEx CEO, right? Those sorts of folks, right? All right, guys, listen. Need one thing from you, one thing only. Smash that like button for me, please. Please do so. I appreciate you, okay? Also, if you want to be subscribed to the channel, feel free to hit that subscribe button. Additionally, pin comment down there today, folks. Almost out of time to get on the email list to receive that Black Friday sale for 1000xstocks.com. We're about to hit 2,000 people on the sign-up list for it. So if you want to join everybody on that sign-up list, check out the pinned comment down there, put in your name, your email, and if you want to receive the offer via text as well so you don't miss it, then put in your number so that way it can be text over as well, okay? Alrighty, guys. So I want to start here talking about Palantir stock. So what is so shocking about Palantir stock right now, okay? Listen, this is huge. Palantir is holding every gain that it was supposed to give up, right? The bears have been predicting the stock was going to crash, it was going to crash, and it was going to crash. And at first, they had a victory, right? And it was very comical to watch this all play out. Let me pull up a 1 month chart so I can illustrate this a little better to you guys, right? So Palantir had a little downfall, and that got all these people really excited. When I say all these people, I'm talking about the bears, all the, people, Palantir's got to crash, Palantir's going to crash, right? And the stock went from 65 down to about $60. And they were saying victory, saying, I knew it. I knew Palantir was going to crash. And now Palantir is just as high as it was previously. It's pretty much right around a new all-time high in the history of the stock. And so all the doomsday folks that are always saying the stock's going to crash, are wrong again. Listen, in regards to Palantir's stock price, right? If we're thinking about when is Palantir's stock price ever going to crash, I'll tell you when it's going to crash. One scenario could be the whole market crashes. That could bring down Palantir, sure. But you could always say that about every stock. Like if the S&P 500 goes down 30%, guess what's going to happen? Every stock's going to get pretty much trampled in that market. That's just what happens, right? What else could cause Palantir's stock price to crash? The other scenario would be growth rates, revenue growth goes back under 30% again. Let's say they had a quarter where they had revenue growth of 24%, 27%. Yeah, if Palantir is $60, $70 a share, it's crashing in that sort of dynamic, and it would be right back down in the 40s. So yeah, if you go from 65 to 45 or something like that, it's a pretty significant crash. So if that were to play out, yes, Palantir crashes. What else could get Palantir to crash? You don't crash a stock based on valuation alone. Can't do it. Ask any great short seller, which is not many because it's a very tough business. It's the most brutal business is short selling. Much easier to be a long stock picker. Trust me, you'll make way more money and it's way easier than trying to be a short seller. But if you ever ask any successful short seller, what is one thing you never short on? Valuation alone. You need it to be high valuation with a fundamental flaw in the company. Maybe there's some sort of accounting issue. Maybe the business model's revenue growth is going to tank, or the profit growth, or the margin growth, like something like that. You need something like that to crash a stock. Just because the high valuation, that's like saying Costco. Costco trades at a ridiculous 50 forward P right now. I think it's even higher than a 50 forward P. It's just insane. It's freaking Costco. Like, what are we talking about here? But to bank on just like Costco stock's going to crash because it trades at a high forward P doesn't work like that. You need something to go wrong with Costco's business model to really get that stock to crash, or you need an entire stock market crash to get that stock down. to hope you're going to get that stock to crash 20, 30, 40% just based on valuation. It doesn't work like that. It never has worked like that. Anytime a stock crashes, it's not because of valuation. It's because there's a flaw with the company. SMCI looked like it had a really rich valuation, right? But you couldn't get SMCI stock to crash just on valuation. You had to have something fundamental. Then all of a sudden the accounting stuff happened with them, right? And the stock crashed like, I don't know, what was it, 70, 80, 90%, something insane, right? That's what happens. So all the people predicting Palantir crashes, it's real interesting. I'll tell you that. It's real interesting. It's real entertaining. And then they go around running victory laps because the stock went down a few percent, all for it to basically, it's going to be closing today likely at an all-time high or very close to an all-time high on that stock, right? And the same people are on X were posting victory laps that were getting 1 million views on X a few days ago, right? Crazy, crazy. All right. Next up here, why is Bank of America talking about Palantir's stocks going to $75 here? Well, Palantir Technologies rose on Monday after Bank of America reiterated its buy rating and upped the price target to $75 from $55 on the software company, citing accelerated U.S. growth and widening competitive moat. The analyst noted Palantir has shown its ability to digitize enterprises and battle spaces from finances to missile production. Quote, in a world where efficiency, innovation, safety, and speed are the most valuable assets, we see Palantir as an enabler and winner in this new era, said the analyst. The analyst is raising the next 3-year government revenue growth to 29% from 24%. Software has become a critical asset in the industrial production, enabling automation, data analysis, real-time monitoring, and process control. Software represents 17% of U.S. non-residential private fixed investment versus 11% in 2005, according to analysts. I'm actually surprised it's not even higher. The analysts think Palantir is poised to dominate as companies turn to software and AI to grow margins rather than through scale with fixed assets. The complexity of the company's ontology is invaluable to the operationalize. Oh my gosh, I cannot pronounce that right. Operational. Damn it. I can't do it. I can't do it. I'm sorry. You tell me how to pronounce it, okay? You tell me how to pronounce it. Generative AI, as it enables the security, governance, and data robustness challenges. Bank of America noted that even with the surge of new commercial customers, partners, and distribution channels, it sees a long runway ahead. The analysts raised their next 3-year commercial growth to 34% from 32%, so that means an even acceleration from here, right? The analysts think Palantir's penetration in both government and commercial applications is early innings. The incremental value-adding use cases, they could have just watched my videos 2 years ago. They could have just watched my videos 2 years ago. They could have watched my videos a year ago, and they would have been on to this, right? They're late to the game. Now, this is what happens with the stock. And you got to understand what's going on here with Palantir, right? This is what happens with the stock. You get Wall Street to come in very late to the game. And it's funny because all of a sudden this year, 2024, has been the year that all of a sudden analysts are jumping over themselves to talk positively about Palantir and to raise price targets. And finally, they suddenly get it. But it's why were they not paying attention before now? Why not? Why weren't they paying attention back when the stock was $8, $10, $6, right? $12. What? Where were they at? Where were they at? But after the stock makes an epic run, it gets in the S&P 500, Nasdaq now, all of a sudden, getting in the queues. All of a sudden now everybody's running over themselves to talk Palantir. Oh, I'm putting out $75. They're late to the game. The big money has already been made on Palantir. Doesn't mean there's not going to be money to be made, but the big money's already made. No different than Meta stock, right? Meta stock, it can still be a moneymaker over the next few years, and it will be a moneymaker over the next few years. But the big money, you already missed it. The stock was under $100 back in 2022. This time last year, it was 2 years ago. This time 2 years ago, Meta was less than $100. Now you got to pay, $550 plus for that stock. So there's still going to be a moneymaker, but it's not the crazy money. Palantir can still be a moneymaker, but it's not the crazy moneymaker anymore. People that were buying the stock at $6, $7, $8, they got the 10x. The people buying it now, they're hoping for maybe a 2x or a 3x on the stock. There's a difference, right? Late to the game. Wall Street's late to the game. Again, that's why you got to beat Wall Street to the punch. You got to beat Wall Street to the punch. You got to look for the opportunities when Wall Street doesn't see the opportunities or they don't care about the opportunities. That's why right now, what do you see me buying? great value and dividend stocks. They're not looking at those right now. They're too focused on what have been the hot things. They're focused on Palantir. They're focused on, Tesla, whatever, right? And that's fine. Cool. Keep bidding those stocks up. Those are big positions for me. I would love that, right? But the moral of the story is you got to look to where Wall Street's not looking at that particular time. Because all of a sudden, a year or two later, they're going to be all over that, right? They don't care anything about these value and dividend stocks right now. And watch out. A year from now, 2 years from now, I bet you, they're going to be all dividend this, value that. This is where you want to position in the market. Yields are going lower. You got to find yield. Dividend stocks are the play. Look at how good they're doing in the market. Blah, blah, blah. Just watch. Just watch how it plays out, right? You got to beat them to the punch. So, no. Is Bank of America correct in regards to kind of their thought process around Palantir? Yes, they're 100% correct. But they're late. They're really late. Like we were talking about this a year ago, 2 years ago. So they're just late. That's what you got to understand. They're not wrong. They're just late. Very, very late, right? It's no different than saying, this football team over here I think they're going to beat this other team by 20 points, right? And then some guy comes in the fourth quarter and that team's beating the other team by 20 points. And like, man, I think that team's going to beat them by 20 points. You're like, yeah, where were we at before the game? Ed Denny.
Research. And Ed, you are joining us on a morning where we have seen new highs once again for both the Dow and the S&P 500. What do you think of this rally that we're on? What kind of legs does it have? And what would you tell people in terms of where they should invest right now?
Well, I think they should stay invested.
By the way, look at SoFi crossing 16, baby. Woo-wee. Run.
It's hard to tell somebody who's been in cash to get into this market right now. Things are not exactly cheap, but clearly those who are getting into the market are going into the small and mid-cap stocks, which have been relatively cheap, and that's fine. And then I think people are also going into the S&P 493, which are cheaper than the Magnificent Seven. But all in all, I would stay invested. The outlook remains fairly upbeat. Clearly, there's risks out there, but the economy has proven itself to be remarkably resilient. I think interest rates have normalized. I don't think the Fed really needs to lower interest rates. And meanwhile, the outlook, I think, is going to be somewhat bumpy with regards to issues of tariffs, but tax cuts and deregulation should be good for earnings.
So the entire idea of, don't fight the Fed if the Fed is continuing to cut rates, that has been one thing that has driven this market. You think the baton's been handed off at this point to maybe a more business-friendly administration that's coming in, and the idea that corporations are going to be able to continue to earn pretty significant amounts of money?
Absolutely. And not only that, I think that we are still in the early stages of a productivity boom. Productivity really was extremely low back in 2015. It was almost down to zero. And we've seen it go from 0.5% to about 2%. So we've seen a quadrupling of productivity since 2015. And I think productivity growth can go up to 3 to 4%, which sounds delusional. But the reality is we've had productivity booms in the past, in the 60s, in the 90s, and they also showed productivity going to 3 to 4%. And this productivity boom probably has more going for it because the technologies that are out there lend themselves to being used by many more business kind of applications than we had even in the 1990s.
You think this is entirely AI driven, or we're still pretty early in the AI run on things? Right.
No, Becky, we've been calling this the roaring 2020 since the beginning of the decade, and so far so good. And it wasn't based just on AI. It was based on cloud computing. It was based on automation, robotics. There's a lot of moving parts here on the technology revolution, and they're all coming together. But I think the key driver is a shortage of skilled labor, and technology is able to augment the productivity of workers. That allows for wages to rise faster than prices, which is actually what's been happening for the past year and a half. So all in all, I think productivity is really the story that's driven the economy so far during the roaring 2020s, and I think it'll continue to do so up ahead here. And I think deregulation helps, tax cuts help. We'll see where the tariffs go. They could be that bump in the road along the way, but I think we're heading to 7,000 on the S&P 500 by the end of next year, 8,000 by the end. Well, 7,000 to 6,000 is doable in my opinion, and then 10,000 by the end of the decade. So that's my Thanksgiving gift to you all.
Okay, we'll take a prediction like that as we head into the holiday.
Right.
Ed,
Yeah, 7,000 call. So the good thing for him in regards to making that call here, if we're thinking, is that call realistic? Here's the deal. Big tech is actually attractively valued right now. And so as a whole, doesn't mean every big tech is a smashing deal, but as a whole, I got to say, if I had to put it in the overvalued camp or more the undervalued camp right now, I'd actually put it more in the undervalued camp. And that's what carries the market. Let's be honest. Like, that's what carries S&P 500. That's what carries the Qs. So if you think about the market going higher next year, how do you get it higher? You got to have those big techs roll. And the setups are actually pretty decent. NVIDIA's floundering right now. I think the stock's in the low 130s, which is, I think, a great setup for the next, 6 to 12 months. If that stock was 200, I would feel very differently about NVIDIA. I would think, we're kind of placing that stock in a stagnation period, right? But now, people have sold that stock off, and now it's in the 130s. I'm like, dang, NVIDIA's not that bad there. So that could set up actually decent. Meta's very undervalued. Google's very undervalued. They do have government stuff, so that's going to be a drag on the stock price, but they're pretty decent, right? AMD's very undervalued right now. So you get a lot of those big tech companies that are very undervalued. So you could get momentum. I think Microsoft's very fair valuation. I wouldn't be surprised if Microsoft went up 10, 20% next year, something like that. Apple, I don't know about. I think they got the most question marks of everybody in big tech. Tesla's going to be, likely showing nice growth in 2025 in their business model. So that should be very good for them. However, obviously it trades at a rich valuation, as Tesla always trades rich, right? So, yeah, his call there, I don't think it's crazy, right? The 10,000 call, that's a little bit crazier in my opinion, just because there's so much that can happen between now and the end of the decade. We could get a major unemployment recession at some point in this next 5 years, right? That could easily happen at some point in the next 5 years. You get a big unemployment recession because of whatever reason. And that's a whole situation you got to deal with. So, because we haven't had a big unemployment recession really, if you want to say the Rona recession, okay. But that was very quick, and then those jobs came right back. And it was basically kind of a government forced recession, obviously. So my opinion is we haven't really had a big unemployment recession since, you got to go back to kind of the end of 2009 into 2010 and where the unemployment rate was at that point in time. So, it feels like we're probably doing this next 5 years at some point to get a big unemployment recession.
A person in an hour who's told us that we should be looking at the other 493 stocks. Peter Bookvar was on with us earlier saying the same thing. How hard is it?
The thing that will put us into the next recession, if you're wondering, a big unemployment recession, it will be inflation. Inflation does not have to go to where it was at previously. It does not have the inflation rate does not have to go to 9% CPI plus, right? Like it did previously. If we just went to a CPI 4, 5, 6%, I think that would be a nail in a coffin. And especially if that happens in the next 2 years, to really just damage the consumer once and for all, because the consumer's starting to come back to life, right? But if we had another batch of inflation in this next 1 to 2 years, that would be devastating. And that would be the moment, because essentially job openings now are far lower than they were going into the prior inflationary cycle. So the next one would be the one that actually that caused a big unemployment recession, where unemployment maybe goes to 6 to 10% range. And that would be ugly, right? And ugly for the markets, ugly for company earnings. But that's not right now. So right now it's party on. But just keep in mind, if you ever get that batch of inflation again, it's going to be it'll be much more devastating to jobs market than this previous batch was. This previous batch hardly moved unemployment up because there was just so many job openings going into it. It's not going to be like that going in the next one, and that's going to be devastating.
Bargains there. It seems like a pretty common mantra that people have been saying for a little while now. Look at those other 493.
Well, I guess my view is when you look at your portfolio, think of every company as a technology company. They either make it or they use it. If they don't use it, they're going to be a competitive disadvantage. And so I think there's a tremendous amount of pressure to use technology. And pressure. I mean, it pays off. And so I think there's still opportunities in technology, believe it or not, and in communication services. But in the rest of the market, I think financials are still have opportunities, industrials, consumer discretionary. I think there's some clunkers, like healthcare is going to be challenged by RFK and Dr. Oz. We'll see how that plays out. And materials and energy are being challenged by a fundamentally weak outlook for the Chinese economy as well as the European economy.
I still remember my mom watching Dr. Oz back in the day. She loved Dr. Oz back in the day. Oh my gosh. Crazy world, folks. Crazy world. All right, let's get into this
Consumption expenditures, that's the Fed's preferred gauge of inflation, in line with expectations today, rising 0.2% from the previous month and 2.3% year over year in October, while core PCE, which excludes food and energy, increased 0.3% on a monthly basis and 2.8% annually. My next guest says while inflation is now close to the Fed's target, tariffs could potentially complicate their rate cut strategy next year. Joining me now is Mark Zandi, chief economist at Moody's Analytics. CNBC senior economics reporter Steve Leisman is with us as well. Guys, happy Wednesday. Mark, how long is it going to take, you think, next year before the Trump policies start showing up in the data? I'm guessing tariffs, even the looming threat of tariffs, might start some action.
Yeah, I suspect they'll start showing up in the data in the spring, summer of next year. It takes a little bit of time, I think, for the tariffs to get into place and implemented. So I don't think it's going to be right away. It's having impacts on markets right away as markets try to digest, what the president has in mind and what he's going to do and when he's going to do it. But in terms of the economic data, the actual inflation statistics, economic statistics, probably not to the spring or summer of next year.
And you say that this data shows that the economy is in a pretty healthy place to handle that. Is that how you feel no matter what the level of those tariffs is?
No, a lot depends on what those tariffs, what they look like, how big they are, how broad-based they are, when they're going to be implemented, the boatload of uncertainty around all of that. And it's not just the tariffs. It's, immigration policy, it's tax policy, it's spending policy. There's a whole bunch of stuff that's going to be going on next year that's going to complicate things. But, I do think the economy is in a really good spot. It's performing exceptionally well. President Trump is getting a very good economy handed to him, so it can weather a lot of whatever he plans to do here. But there's a lot of script to be written and a lot of different policies that will impact how this plays out next year and into 2026.
Steve Leisman, speaking of immigration, the personal income portion of this data up 0.6%. That's still pretty strong.
Yeah, consumers look like they're in good shape. The spending numbers were a little bit lower than that, which meant the savings rate went up, though there was a bit of a revision to the past. I think one of the great hopes of retailers seeing those numbers, assuming they were looking at them, is that people were holding their powder for the holiday season. Remember, these are October data. Well, we know that they go into the November and December holiday shopping season in pretty good shape relative to their wallets. Inflation is an issue to an extent, though I will say the goods numbers in the PCE report were minus 1%. And that's one of the dangers of the tariffs here, which is that the way we've been able to kind of have this, call it 2.5% to 3% inflation, is negative numbers on goods and positive and sometimes too positive numbers when it comes to services. The tariffs will get right at the part that's keeping down the inflation rate. And to your question about when we're going to know this, Mark is sort of hopeful about the spring. I don't know if it happens in the spring, and I don't know how long the Fed sort of holds its powder or begins to start to think about the idea of whether or not monetary policy needs to address the fiscal side. As you said, John, there's a lot of stuff in the works. When all this shakes out, maybe till the second half of the year before it's evident in the data. And then if the Fed waits till it's evident in the data, not until that time do you get some response from the monetary policy side.
Yeah, so in regards to how I view, a new president coming in, a new administration, how long it takes things to really start to help or hurt the economy, whatever way you want to view it, my opinion is it really takes about a year. The first year, you're just trying to get all your stuff together, get things done, right? get things through. But until it really starts to affect the economy, positive or negative, it really, you're talking about the next year, really, right? So I would really say if you're thinking about Trump's positive effect on the market or negative effect, whatever, or economy, it's really 2026 and beyond, right? That first year, you're really riding off of the last guy, right? And so, let's say, Obama's first year after Bush, that was still kind of Bush's situation there, right? Trump's first year after Obama, his first year was still really Obama, right? Biden's first year after Trump, that was really Trump, right? Which, by the way, Trump deserves a ton of the blame for inflation. People don't talk about that, and they look the other way, but he deserves a ton of the blame. But people, they don't really understand how economics works, and so that's fine. But the moral of the story is it takes about a year. So if you think Trump's going to, positively affect things, I would really look out to 2026. Amex.
The CEO's favorite small businesses. I did sit down with him, Steve Squeri, CEO of Amex. The company's stock has had a monster year, hit an all-time high today. I asked him about his specific targets, whether it was too aspirational to keep a 10% revenue target for the year when revenue so far is tracking 9%. Here's what he said.
I don't think it's too aspirational, and I think it's really important to challenge yourself and challenge the company. Look, when we set that target, what we wanted to do was to put that bogey out there to say, hey, look, we're going to continue to grow. And, look, we're going to grow, as we said, we're probably going to grow more to the 9% range. But I think the important part is we've raised our EPS targets twice this year. And what it shows as we've gotten more and more scale in this business, we're able to generate more operating leverage and we're able to generate earnings. And so whether we're at 9, whether we're at 10, or whether we're at 8, we believe we can still hit that mid-teens EPS growth because the scale and the flywheel effect that we have is really powerful. It's really powerful. And the other thing that I point out is that, when you look at our business is really a three-legged revenue stool. We have the fees that we have from merchants, from spending. We have card member fees, which for 25 straight quarters now has been in double digits. And we just had 18% growth in the third quarter. And then we have our, interest income. But 75% of our revenues come from fees and not from interest income, which is very different than our card competitors. And that speaks to the engagement of our cardholders.
There's also a ton of optimism around the Trump election, and in particular, banks and consumer finance companies have done very, very well. What do you think is the impact going to be on your business? Yeah,
look, you saw a huge run up in the financial services stocks, since the election. And I think, look, it'll all have to play out. But I think what businesses are thinking about is that it'll be a pro-business administration, that regulation will be rationalized. And I think, corporate tax increases are probably not going to happen. So I think those things in general are leading to this euphoria.
But deregulation in particular around your sector?
I wouldn't say deregulation. What I would say is more rational regulation.
What does that look like?
So I think it's, we've had some, things with the CFPB in terms of late fees. We've had some other issues, and I think it'll be a more balanced view. I think we've had issues around, everybody talks about Basel III Endgame and what that's going to look like. And I think that there's a new rule that's written. We'll see how that plays out. And both of those things are really important because the Basel III Endgame is about capital. And if you have to hold more capital, and look, we want a system that is stable, but if you have to hold more capital, that prevents your ability to lend money from a lot of banks and for us as well. And I think when you look at sort of the late fee issues, it will cause some unintended consequences. What it will cause is higher interest rates because companies are going to have to make that money up somehow, and it could cause bad behavior on the part of cardholders because they won't pay their bills on time. So I think in those kinds of areas, we'll see some rationalization.
There's also the Durbin credit card bill, which he is trying to revive here for a vote before a lame duck Congress.
And we'll see how that all plays out. I just point out that is not a bill that is targeted at American Express because we are a three-party system versus a four-party system. And so we'll see how it all plays out.
So it doesn't impact you as much?
It will not impact us.
At all?
No, because we're a three-party system, so our transactions will continue to be routed to American Express.
And then what about the merger of your competitors, which maybe has a higher likelihood?
Yeah, and I think that has a higher likelihood of going through. But I think, I think it's Rich Fairbanks is a great executive and a brilliant guy. And I think for him, it's a good opportunity because what he does is he gets his own debit network. He'll get he'll have more scale from a lending perspective. I think he'll become the largest credit card lender in the United States. From a premium perspective, though, he's going to keep most of his volume on the Visa MasterCard network.
So it's not a bigger competitor for you?
No, I think, because the Discover pricing model is not quite as good from a premium perspective as the Visa pricing model is. And so I don't see them taking as much advantage of that closed loop as in the short term. I mean, again, I'm not putting anything past Rich because he's a really smart guy. But in the short term, I don't think this is going to have a real big impact on our business.
Yeah, well said. I like him. Amex CEO, I like him. I think he's a straight shooter. I appreciate that, okay? All right, guys, appreciate you joining me as always. Thanks so much for being here. Hope you enjoy that Black Friday deal. It's coming very shortly here. If you want access to that will be pinned comment to everything that 1000xstocks.com has. Every single feature, every single education portion, all that good stuff. So, yeah, once again, pinned comment down there. Much love and have a great day.